A free trial begins with a price of $0, but the billing system may already know the customer's payment method, the product has started delivering service, and a conversion clock may be running. The customer thinks they are testing an app, membership, or stream. The company thinks it is buying a chance to create a paying relationship. That chance is not free to the company. Servers run, music plays, support answers. Marketing brought the user to the offer. A platform may handle the subscription, and a payment network may store the recurring authority. The price shown during the trial can be $0, while the acquisition and service costs are already real. 3 offers can look similar but work differently. A free tier can continue without payment. A hard stop trial ends unless the user chooses to buy. A free-to-pay trial becomes a paid subscription unless the user cancels. The first 2 require a new buying decision. The third treats inaction as the decision already authorized. The basic equation is simple, even when the inputs are private. Multiply the share of users who convert by the contribution each paid month can produce, and the number of months they remain. Then subtract acquisition, trial delivery, platform fees, payment costs, support, refunds, and ongoing service. Conversion opens the account. Retention decides whether the account becomes valuable. That is why the trial cost cannot be measured only as foregone subscription price. It can include advertising, affiliate payments, cloud usage, licensed content, fraud screening, customer support, and the failed payments or refunds that arrive after conversion. The cheapest digital sample can still sit on top of an expensive commercial system. Why accept that cost? A trial can remove uncertainty more effectively than an advertisement. The customer can hear the catalog, use the editing tool, follow the training plan, or test the workflow inside ordinary life. If the product creates enough value before the clock expires, experience performs part of the selling that marketing could not. Spotify describes that funnel in its annual report. The company says new premium subscribers are primarily sourced from people using its ad-supported service. It also says trial programs help convert users into full premium subscribers. Free listening is both a product and an acquisition channel. A limited trial adds another bridge from interest to payment. The timing is deliberate. Spotify says premium subscriber growth has historically accelerated when it runs free or discounted trial programs. Since 2022, it has run 3 programs each year during the second, third, and fourth quarters. The filing proves that trials are an active growth lever. It does not disclose the conversion rate or profit of each campaign. The more important metric begins after conversion. Spotify says premium subscribers who use the service through multiple devices have higher engagement and lower churn, which increases expected lifetime value. That is the business hidden behind the countdown. The trial gets a user through the door. Habit, utility, catalog, and product integration determine how long the revenue stays. Spotify reported a 34% gross margin for its entire premium segment in 2025. That number includes paid subscriptions, licensing costs, platform relationships, plans, markets, and much more than trial cohorts. It is useful because it shows contribution exists after direct costs. It is not a free trial margin, and it cannot reveal whether one promotion paid back. Duolingo shows a different version of free. Its learning content remains available without a deadline. The company says free users spread the product through word of mouth, create advertising inventory, and complete exercises that support large-scale experimentation. Here, a user can produce business value without ever crossing a trial expiration screen. In 2025, Duolingo said paid subscribers represented 9.2% of average monthly active users. The filing excludes people currently on free trials from its paid subscriber count. That ratio describes paid penetration across a freemium system. It is not a trial conversion rate, and it should never be compared directly with an undisclosed Spotify campaign. This distinction changes the incentives. Freemium can monetize attention while waiting for voluntary upgrades. A hard stop trial must persuade the user to act before access disappears. A free-to-pay offer places payment at the default destination. Each design can reduce purchase risk. Only the last design turns silence into a charge. That last design needs infrastructure. The customer selects an offer, confirms terms, supplies or activates a payment method, and receives access. The merchant or platform records eligibility and the future price. If the customer does nothing before expiration, the stored authority becomes a paid recurring transaction. A $0 experience has created a timed payment instruction. Apple provides one public example. Its developer guidance says a free trial subscription begins immediately and renews at the standard price when the offer ends unless the subscriber cancels. Apple also says developers normally receive 70% of the paid subscription price during the first year and 85% after a year. Platform programs and taxes can change that split. Google Play exposes the same machinery with different controls. Its current documentation lets developers configure acquisition, upgrade, win back, and other offers. A free phase can last from 3 days to 3 years. When the free or discounted phases finish, the subscription renews at the base plan price. The platform turns trial design into configurable billing logic. Behind both platforms is a longer chain. The service defines the offer. The App Store or merchant records consent and entitlement. A processor routes the transaction. A card network carries recurring credentials and rules. The issuing bank approves or declines the charge. The customer sees one subscription line, but several systems divide the economics, responsibility, and evidence. MasterCard's network rules show how payment infrastructure can govern the transition without becoming legislation. For qualifying digital trials longer than 7 days, the June 2025 rules require a reminder 3 to 7 days before expiration. The notice must include basic subscription terms and clear cancellation instructions. That is a contractual network standard, not federal law. The first successful charge is still not the entire revenue story. Duolingo calls the money received from subscription purchases bookings, then explains that subscription revenue is recognized across the life of the subscription, usually 12 months. Cash can arrive at the start. Accounting revenue follows the continuing service that the company still owes. This is the second clock inside a trial business. The acquisition clock asks whether a user converts. The revenue clock asks whether service is delivered across the paid term. Refunds, cancellation, failed payment, platform fees, and support can intervene between them. A card charge is an event. A durable subscription is an obligation performed over time. For covered online negative option offers, current federal law already sets a baseline. The Restore Online Shoppers Confidence Act requires clear disclosure of material terms before billing information is obtained, express informed consent before charging, and a simple mechanism to stop recurring charges. Those requirements survived the collapse of a different federal rule. In 2024, the Federal Trade Commission finalized a broader rule commonly described as click to cancel. It would have applied common disclosure, consent, and cancellation requirements across many negative option programs. Before its main compliance date arrived, businesses challenged the rule. A federal appellate court reviewed how the agency had created it. In July 2025, the United States Court of Appeals for the Eighth Circuit vacated the entire rule. The court found a procedural failure. The agency did not issue a required preliminary regulatory analysis after the expected economic impact crossed the statutory threshold. The court also said it was not endorsing unfair or deceptive practices. Other laws remained. In March 2026, the Federal Trade Commission opened a new advance notice inquiry. It asked for evidence about negative option markets, enrollment, consent, cancellation, costs, and possible regulatory alternatives. The agency reported more than 100,000 related complaints over 5 years. That is a complaint count, not proven violations, and the inquiry is not an effective rule. California has its own current framework. State law defines a free-to-pay conversion as free access followed by an obligation to pay unless the consumer cancels. For covered contracts entered into, amended, or extended from July 2025, businesses must present terms clearly, obtain express affirmative consent, retain verification, and provide an accessible cancellation method. The California law also creates a specific reminder window for some longer offers. When a covered free or discounted period lasts more than 31 days, the reminder must arrive at least 3 and no more than 21 days before expiration. That is a state rule with conditions and exceptions. It is not a universal national timer. Enforcement shows why these distinctions matter. In 2020, Age of Learning agreed to a $10 million judgment to settle Federal Trade Commission allegations involving ABC Mouse. The agency said automatic renewal was inadequately disclosed. authorization was missing, and cancellation was difficult, including for a 30-day free trial. A settlement resolves allegations. It is not an industry verdict. The scale can be much larger. In 2025, Amazon agreed to a $1 billion civil penalty and $1.5 billion in consumer refunds to settle allegations about Prime enrollment and cancellation. The entered order requires clearer disclosures and an easier path out. Those amounts measure one enforcement resolution, not the profit produced by free trials. Some current matters are still only allegations. In January 2026, the Federal Trade Commission sued Just Answer, alleging that small join fees led consumers into recurring monthly subscriptions without clear terms or affirmative consent. The case was pending at the research cutoff. No court had found liability, and the complaint cannot be narrated as a verdict. These cases reveal a weak version of the model: increase conversion or delay cancellation through confusion, then absorb complaints, refunds, payment, disputes, enforcement, and distrust. That may lift a short-term metric while damaging lifetime value and increasing cost. A recurring charge that the customer did not understand is not the same economic asset as a subscriber who keeps choosing the service. The durable free trial business is less mysterious. Give the customer enough product to reduce uncertainty. Convert with clear terms. Deliver enough value to retain the subscriber. Pay the platform, network, content, support, and service costs. The hidden margin is not zero price becoming money by magic. It is informed conversion multiplied by time, minus everything required to earn that time.